I'm Adrian Manz, and in this seminar, I want to talk to you about the difference between traders and investors. I would like to go over some of the psychology involved in trading, the discipline involved in trading, get into what trading software typically looks like and what it should be able to do for you, and then get you ready for session 2, in which I'm going to start diving into the strategies that we use as traders and that I think really can make a big difference in your ability to find opportunities in the markets. So let's get started, and let's first off just talk about who the investor is. So an investor is on a wealth building mission, right? He's looking to buy stock, and he or she wants to put stocks and options and commodities and whatever else into a portfolio, and wants that portfolio to increase in value over time and hopefully produce some dividends and other good stuff along the way. Now, this is a long-term time horizon that the investor is looking at. So typically, if you're investing money in the markets, you want to be looking at least 10 years worth of future market data that you're pinning your hopes on, right? So an investor's not looking to get in and out of stocks. He's not looking to trade stocks. This person, whether he or she is investing through a 401k or investing on their own, is looking to put together a bundle of things that is going to make life easier down the road. As such, an investor is typically going to focus on fundamentals. So by fundamentals, I mean how a company is performing, what the growth prospects for a company are, what the historical growth is, whether or not there's dividends. The investor is not looking at stock charts to figure out where technical levels are the way that a stock technician does. The investor is looking for good companies with good potential and is going to pop those into a group of other holdings, and over the long term is hoping that those good fundamentals inherent to the companies that are being put into the portfolio are also going to lead to some good growth overall. Now, I said 10 years, right? This is because an investor is going to tolerate some pretty wide equity swings. So you could buy Apple at $120 a share and see Apple go back down to $90 a share and not worry about it if you're an investor, because you believe in the company, you believed in the company's earnings potential, and over time you believe it's going to come back and it's going to make a big move to the upside for you. This is very different than the way that a trader would approach things, and we'll get into that in a second. But let me first say that this person is going to have minimal transaction costs. And by transaction costs, I'm referring to commissions. The investment horizon is such that if a person starts putting things into a 401k or starts buying things for a retirement fund that they're putting together themselves, or just their stock portfolio, they might rebalance that once a year. They might shift what they've got in the group, but they're not doing a whole lot of trading, right? So there's not going to be the exorbitant commission impact that you would see if you were in and out very, very frequently. So it's not very often the concern of the investor that they are paying the lowest commission possible, whereas that's, of course, very true for traders. And finally, for the investor, returns are going to be correlated to something. Most frequently, they're correlated to the indices that the stocks and bonds and commodities, or whatever the investor has chosen to focus on, are most strongly associated with. If someone, for example, decides that they're going to focus on retail stores, then there's going to be a correlation between the consumer discretionary index and the stocks that are in their portfolio. The index is going to have a strong similarity in the way that it moves when compared to the stocks that are in the investor's portfolio. Now, the trader, on the other hand, is a lot busier in terms of dealing with the markets. That's because a trader is seeking to create income. And a lot of times when you'll hear guys talking about their trading activities, it sounds almost too good to be true, right? That they're generating let's say a 15 or a 20% return, and you'll say, well, that's just not possible because the S&P 500 only did 5% over the same time period, and how could this guy be so smart? Well, the reality is the trader is working much harder at what they're doing than the typical investor. The trader is working at this as if it's a job, and people who work jobs need to get paid. So either you're able to create income or you wind up not being a trader for very long. The time horizon is going to be very short. So traders operate in time compressions that could be as short as just a few minutes or as long as a few days or a few weeks or even a few months, depending on if they're intraday traders or if they consider themselves swing traders. And there's a big difference in terms of how they're treated by the Securities and Exchange Commission, how much leverage they're permitted to have. It's based on how much risk they're carrying overnight, really. So if someone has a very short time horizon intraday and they qualify for a pattern day trading account, which means they have about $30,000 in the account that they can work with, then they're given 4-to-1 leverage. They can trade 4 times their money. Whereas if they're trading overnight, they're given 2 times their money to work with. So that leverage is adjusted because overnight trading carries a little bit more risk. You could have a surprise. You could have something bad happen on the open. Market draws down. I think we can agree we don't want to be 4-to-1 in an overnight position. But during the day, you've got much tighter controls on what you're doing, and you can limit your risk. Hence, more leverage is available. Traders are typically very technically focused. They focus on things like stock charts, indicators. They have proprietary systems that they develop, right? We all look at different things when we approach the markets. Some people are entirely focused on trading with oscillators. Other people swear that using oscillators is the worst thing in the world and you want to go straight with price data. My theory on this whole thing is that you have to find what works for you, and that's what you stick to. I don't use a whole lot of indicators on my charts. I like to follow just price and time and figure out what the market's doing based on that. But if you've got something that works for you, then I say by all means you stick with it. We tolerate much smaller equity swings as traders. A swing trader who establishes a position, for instance, that's intended to last maybe a month or so might only have about a $2 stop loss on that or a $3 stop loss on it, whereas an investor might not even have a stop, right? They're looking at this thing totally differently. An intraday trader might very well say, I'm not going to tolerate more than a 30 or 40 cent per share move against me before I exit this position. That has to do with the type of profitability that you're expecting, as well as the time frame that you're looking at when you establish your positions, and finally the share size that's being used. So typically a day trader is going to have a lot of shares committed to a position, whereas a swing trader might have a much smaller position. So sometimes that difference can be 10-to-1. A day trader might have a position that's 10 times the size of what a swing trader would use. Other times they're a little bit closer, but generally speaking, the shorter your time frame, the smaller the equity swings against you that you're willing to accept. Traders do incur high transaction costs, so it's very important in the world of trading that you engage with a broker who's giving you the most favorable costs. Typically, commissions don't really exceed about $5 per trade. That manages to keep things pretty well in check, but you have to consider that on some strategies, you might be looking for swings of only about 10 cents or so. So if you're trading 100 shares and you're incurring a $5 commission on the way in and a $5 commission on the way out, and you're someone who's hyperactive in the market and you're looking to pull 10 cents in profit per share out of your trades, well, if you're only trading 100 shares, then even if you make your profit, you've really only made enough to cover the cost of getting in and out. That's why you hear people who are referred to as scalpers, who typically take much larger share size. They'll take 1,000 shares of something, and then if they have a 10-cent profit, it's $100, which still carries a transaction cost of $10, but at least it's not wiping out their ability to profit. So these are all just things to keep in mind. Finally, as I said, the trader is very technically focused and develops strategies that are based on the technical factors that they believe in, and returns in any market are going to be based on how good that strategy is at generating returns. A strategy that works for one trader may not work very well or at all for another trader. This has to do with what's going on between your ears, right? So inside the trader's brain, you've got this strategy. and that strategy looks like it's going to be a winner. Now, for most traders, strategies are based on empirical evidence, right? They've seen something work enough times that they thought they could develop a system around it, develop a strategy that they can deploy every day and make it work. Those are the best kind of strategies, right? When you develop something and you watch it and you paper trade it and you get used to the rhythm, create logs of how it performed, and you've got something in front of you that shows you, yep, this thing works, this is why it works, this is how it works, I understand it. What that leads to when real money is on the line is replicability. So not all strategies are replicable, right? You will see things that are out there and you read about them in a magazine or you read about it online and it seems like it's the greatest thing in the world, and then when you go and try to apply it yourself, you can't pull it off. So there's a bunch of reasons for that divergence. The most important of them in terms of the strategy itself have to do with you need to make sure that you fully developed it and that any actions that you're going to be taking are based on live data and simulation with that live data where you were able to replicate what you thought you saw or what the author of a strategy told you was going to happen. But another big factor here is psychology. And as many of you know, I'm a psychologist. My wife Julie and I are both trained in psychology. Both of us have PhDs in the discipline. And what we can tell you is that inside every trader, there is a balance going on that very much affects how they think. And the first component here is tolerance for risk. So a very good strategy put in front of two people is going to behave very, very differently based on how much risk they're willing to accept. And this is really something that's different for everyone and something that very, very many trading educators and authors tend to overlook. There's something going on in everyone's head that determines where their comfort level is, what the sweet spot is in terms of how much risk that they're willing to accept. And the interaction between that and your trading has to do with a couple of things called fear and greed. And these interact with that risk tolerance, right? So if you're afraid of losing, then what can happen to your trading strategy is that when you were looking at the live data, when you were looking at your simulations, you were very, very good about putting those stops in place, very good about following the system that you've developed or the system that was developed, and everything went fine. But then you get into trading it yourself, and all of a sudden you're watching real money and you're watching a drawdown. So let's say you're into a position and all of a sudden the stock's going against you and you're watching the money tick away. Well, if you've got a low tolerance for risk and the strategy that you're using has a high tolerance for risk, it's a bad psychological fit and it's going to generate fear and apprehension and make you a very nervous trader, and that's a very difficult way to do business. And it might be obvious that losing money is something that can create a fearful situation, but I've seen just as many traders over the years who have a negative outcome with a particular strategy, and that's based on the fact that inherently they're kind of greedy, and once they get a trade that's moving in their favor, they're not willing to follow the strategy and take their profits. What they do instead is try to push the trade, and then when it pulls back or starts losing profitability, they start focusing on the fact that they'll get out when it gets back to being profitable or when it gets back to their profit target, and it leads to all sorts of violations of strategy. And once you start violating the rules, you really don't have a strategy at all. You're just kind of randomly trading the markets, and that's never a recipe for success. What that then logically leads us to is discipline. You need, as a trader, to be able to methodically follow a strategy day in and day out in every kind of market condition and know that deviating from it is not the solution. And here's the reason for that. I'm sure that most of you are familiar with a situation where you get into a trade and then you look at it and you say, you know what, I'm going to pull the plug on this one. I don't like it after all. Even though the system's telling me to stay with it, I'm going to bail out here. And then it winds up being a good decision. Stock goes against the strategy. Had you stayed in, you would have had a much larger loss than you endured by getting out early, and you pat yourself on the back, and everything's coming up roses for the day. Then the next day, or maybe the next week, you see the same thing happening again. Oh, I've seen this before. I know just what's going to happen here. And you pull the plug on a trade. And then the trade turns around and goes in the direction that it was originally supposed to by the strategy. And it does it without you. And now you've got something called dissonance going on, right? You've got a bad psychological fit between what's happening and what you just did. And once cognitive dissonance is working on a trader, it's very, very difficult to undo. So in my thinking, it's just better to develop strategies that have proved themselves, on paper, and then decide whether or not your psychology is going to allow you to trade it the way that you intended to trade it, or the way that the author of the system intended it to be traded, and that then you have the discipline to see it through, to follow it from bell to bell, and make sure that you're doing things just the way you intended to, and that then is how you measure your success. The success is not whether you made or lost money on the session. The success is measured by you followed the rules of your strategy. Now let's talk about the tools that a trader uses, because these are going to be similar to, but very much expanded compared to the tools that an investor uses. First and foremost, we've got stock charts. Most traders rely heavily on charting and are using charts over the course of the day to make the decisions to get them in and out of positions. Technical analysis studies applied to these charts are the roadmap that a trader uses to get through the day and find a little bit of guidance. The only studies that I plot on my charts are price, volume, and volume by price. And then I've got trend lines, and I also use floor trader pivots. So I'm a little different than a lot of guys. A lot of guys are using oscillators, or using stochastics, RSI, rate of change. There's a bunch of momentum indicators that you can use. Since I'm so glued to the charts, I don't find those particularly helpful. Other people like to be able to just get a snapshot of what's been happening while they've been away from the desk, or like to get a little bit of clarity on what it is that they're looking at. But as I said, you're going to find what works for you, and that's what you have to focus on. The price and liquidity quote is how you figure out where you're going to get in and out of the market. And your order entry and routing is how you're actually going to establish and liquidate positions. In terms of managing your trades, this is also something that your tools are going to handle for you. And I'm going to show you that in a second. But let's start with the stock charts. Let's just take a look at each one of these things and make sure that everybody's on the same page before we move on to the actual strategies. Here we're looking at a bar chart. This is an open, high, low, close bar chart. This is called an open, high, low, close because of the way that the bars are constructed. We'll get into that in a second. But the first thing you want to look at anytime you're looking at a chart is going to be what the time compression is. So these are daily bars. Each bar here represents the price movement that Apple had on a given day. We've got 1 day of trading in every single bar on the chart. The top of a bar is the high price. The low of a bar, the bottom of a bar, is the low price of the day. And if you see a tick like this that's off to the left side of the bar, horizontal tick on the left side, that's going to be your opening price. And when you have a horizontal tick on the right side of the bar, that is your closing price. If you look at the bottom of the chart, most people have a histogram on the bottom of the chart that tells you what the volume is on any one of the given bars. So in this case, each bar here represents the daily volume that Apple transacted. So red or green means up or down volume, typically for the session. All right, so if it opened high and closed low, it's going to be a red bar. If it opened low, closed high, that's going to be a green bar. And as you can see, Apple ranges from about 15 or 20 million shares a day all the way up to 70 million shares per day. Out on the right side of the chart here, we've got something that is unique to a piece of software called Realtick. It is volume by price. So what this volume histogram shows you is how much volume was transacted at every single price point on a chart. So on the bottom, we're looking at time or days when you're looking at a daily chart. And on the right axis, what you're looking at is volume by price. Now take a close look at this chart. What's different here? Well, you can create charts in any time compression. As I told you, you can have charts that are daily, weekly, monthly. In this case, it's an intraday chart. And what we're looking at here is 5 minutes of trading in each and every bar. So if you look in the upper left corner in this particular piece of software, again, this is Realtek. It shows you the time compression is intraday. It's 5 minutes. And each bar then is going to represent 5 minutes of trading data. Other than that, everything about this chart is the same as a daily chart. The volume on the bottom is the volume of each bar. The volume on the right is the volume of each price. And you can see it looks very much like a daily chart. So it's important when you're looking at these things that you always go and determine the time compression that you're looking at, right? Because some stocks can look like they're in a terrific uptrend. And I've actually had guys tell me they bought a stock for a swing trade because it seems to be doing so well. And I said, you're looking at a 5-minute chart, not a daily. And on a daily chart, the stock was actually moving lower. So always make sure that you're very familiar with your tools and that you know how they function. This is the real-time market depth. So these are stock quotes. And on the right side, you see a ticker tape. Stocks are bid over on the left side of this montage. At the very top of the list is the best price that anyone is currently willing to pay for the stock. So on this day, at this particular time, 149.73 was the highest bid for Apple. Also note that you can tell how many shares people are bidding, and you can use that to anticipate the effects of buying pressure. On the right side of the montage, over here, we have the ask price. So this is the best or lowest price that anyone is currently willing to sell the stock for. So 149.74. So there's only a penny difference between the best bid and the best ask when you're dealing with a supercap like Apple. That's because there's so many shares going off and so much liquidity for it that even in the pre-market, it tends to be spread much tighter than many stocks are over the course of the session. And finally, also remember that that size column there represents how many shares are for sale at each one of these particular prices. Now you can see here in my montage, each level has a different color. That's just the way that I've got it set up. There's a million ways to set up a market maker or a market depth montage. This is just how I've had mine set up for the last 20 years or so, and we're all creatures of habit, right? So I don't like to change this too much. When you're entering orders in a direct access order system, they can look pretty similar to what you're doing in a portfolio management system or in something that's really designed to handle trades over the longer term. Here you see that we have the ability to set a limit order. This is the worst price in this case that we're willing to pay, let's say for Apple, 149.10. Probably familiar with that from any piece of software that you've looked at. Got the quantity we want to buy, got the price we want to buy it at, and then we also have the ability to enter stop orders. Now, stop orders aren't allowed by the exchange anymore, but the software and your broker still handle them pretty much the way they always did. In this case, we've got a stop limit order, the stop price 149.05. So now if Apple gets to $149.05 per share, something's going to happen. That's not my stop loss. That's just a stop price. That's an activation price. And what's going to happen? I'm willing to buy it all the way up to 149.10. 149.10 is the worst price that I'm willing to accept. 149.05 is the level that the strategy tells me to start buying. All of this stuff in the circle here, pretty much going to be something that most people are used to seeing if they've been handling their own investing over the years. Not very different in the trading landscape. Trading software does, however, escalate in terms of what it can do for you. So in this case, now we're looking at conditional order. This has a price time trigger. It says that if Apple's last price is less than or equal to 149.04, then let's initiate that buy order. The stop price, 149.05, the worst price we're willing to accept, $149.10. And why might we be doing this way? Just think about it for a second. Why do we want to say if Apple's last price is less than or equal to 149.04, then we'll go ahead and buy it at our levels? Well, what you should focus on is that less than or equal to value there, because what that tells us is we don't want to buy Apple if it's falling down through 149.05. The particular strategy that we're using wants to buy Apple if it's climbing up through 149.05. So that's the reason that we're putting a conditional order on it. And this line right here, this price trigger, and there's other types of triggers available, but we're not going to get into those here. This line is allowing you then to customize the order and give you a little bit of time to look at something else or just step away from the screen. The machine will handle this for you. As long as price remains below 149.04, these parameters are going to be the ones that trigger an entry into the stock. In this case, we'll be buying 500 shares of Apple, and we're going to anticipate that we're going to get filled somewhere between 149.05 and 149.10. As you get more and more familiar with a piece of software, there are more and more options that become available to you. Let's look now at another order that's available in direct access software. This is an OCO order. So assume that you bought some shares using a limit order, and now you're in the stock and you want to manage an exit. You want to step away from the machine and you want the machine to automatically handle the rest of the trade for you. Well, here in this OCO order, or order cancel order setup, what we can do is tell it to buy Apple, and we can change that upmarket profit area there. We can change this to, let's say 149.50. So if we made our anticipated profit target of 149.50, we're going to get out for a profit. And we can say if we hit a stop loss of whatever value, it could be 149, could be 148.50, it could be anything that your strategy dictates. It's going to get us out, though, at that stop price. And you'll notice that this allows even for the initiation of different types of orders. You can use a limit order, you can use a market order, you can use stop limits, you can use stop markets. All of your better direct access trading software is going to have a large variety of order types available for you to work with. So this is called an OCO order, and you should notice here that there's one thing missing on this OCO, right? It's not totally automated. You had to get into the trade to begin with. You can also use something called a bracket order, and bracket orders are a really neat order type. So in this case, we can tell our software that we want to buy Apple. 149.05 is going to be our activation price. 149.10, the worst price we're willing to accept. Then once we're in, if Apple hits 149.50, we want it to exit 100% of our position. And if Apple drops to 148.95, we also want to exit. So that's our stop loss. So our stop loss and our profit target and our entry can all be entered in the same place. And we can even do fancy things like use offsets to declare this as a strategy, and then use that strategy to enter Apple at other prices over the course of the day. So besides strong psychology and a good strategy, what's it take to get into trading? Well, obviously it takes some capital. There are capital requirements for this type of trading that are not in place for investment accounts. Usually you're required to have a PDT account. That's called a pattern day trading account. And what that means is that if you want to execute 4 or more day trades, 4 or more times you're going to be in and out of stocks over the course of 5 business days, then there has to be a minimum balance of $25,000 in the account at all times. That's because you're trading in a margin account. And your leverage, your buying power is going to vary depending on the stocks that you're trading, but generally speaking, the amount of margin that you're going to have is going to be 4 to 1. So for a $25,000 account, you've got $100,000 in trading capital, and that's for all the trades that are placed and closed during the same trading day in which they're opened. Now remember earlier I said really $30,000 was the minimum, and if you look at these numbers, you should put together pretty quickly why that's the case. Because if the minimum balance is $25,000 and you're working with your 4 to 1 leverage, and you get into a trade, and then you get into another trade, and let's say you do 5 trades over the course of the day. And on each of those trades, you neither made nor lost money. What happens at the end of the day? Do you still have the $25,000 or do you have less? You have less, right? Because even though you had a 0 for each trade, you paid a commission for every time you entered the stock and every time you exited the stock. So immediately you're below the $25,000. This is why I said it's always better to have $30,000 to put to work in the account. And most people would tell you that you need to have $50,000 in an account to be properly capitalized. Now, that money, that trading capital, is not the same thing as risk capital. So your risk capital in the account is going to be determined by you. How much are you willing to risk? Well, if you've only got $25,000 in the account, then you should see you're willing to risk zero, because after one loss, you're going to be below the PDT limit. If you have $30,000 in the account, that doesn't mean you're willing to risk $5,000. It just means you want to make sure that you're in excess of the PDT requirement. You might decide you're willing to risk $100 a day. You might decide you're willing to risk $50 a day. You might decide you're willing to risk $1,000 a day. Risk is all about you and what makes the situation acceptable, palatable, what puts you in a place that you have got risk that matches your financial situation. Now, there are exceptions to the PDT requirement. There are offshore accounts, there are corporate accounts, and there are proprietary trading accounts. All of these essentially try to accomplish the same thing. They try to allow you to trade with just the portion of capital that you call risk capital, and the firm is allowing you to use their capital, leveraged very highly usually, in order that you can trade. Now, I'm not making any kind of recommendations here. I have never traded in any of these types of entities. But if you're interested in more information, I can definitely tell you that there's plenty out there on the internet. They may very well be the only way to go in certain situations, so I just wanted to make sure that we told you about it. Now, there's a final way that you can trade that's not really great for intraday traders, and that's to have money in non-margined, or what they call a cash account. And the reason I say it's not great is because you can only go long, and very many times over the course of the day, I find myself shorting a stock as opposed to buying the stock. And since that's part of my strategy, it would never work for me to have a non-margined account, because you can't short stocks when you don't have margin. So there you have it. That's just a quick run through of what I consider some basics, just to get some of you who are coming in from an investing background more familiar with some of the nuances, some of the differences between trading and investing in terms of the tools that we use and in terms of the psychology that's going to need to be in place. The next thing that I'd like to do is get into some strategies. And the strategies that I'm looking at, they run the full gamut. So we do everything around here. It's either going to be opening gavel to closing bell. We've got strategies that are just first hour strategies. We have strategies that can be used as last hour strategies, but a lot of it is about pattern identification trading and momentum and price action trading. That's going to be the focus of most of what we're going to talk about in the modules that are coming up. So now that we've got a little bit of the basics out of the way, I would like to move on and get right into what I consider to be one of my best strategies. I've been working on this one and promoting it since 1999. I really like it, and I think you're going to like it too. So take a little break, and when we get back, we're going to look at an expansion of range and volume strategy that I called fastball in my book, Around the Horn, A Trader's Guide to Consistently Scoring in the Market. All right, now let's get into the stuff that everybody wants to talk about, including me, right? The psychology and all that is great, and the discipline, but people like to discuss strategies and talk about the way that they like to approach the market. So let's dig right in. And I'm going to tell you that I consider strategies to be pretty simple, right? I don't have very complex strategies. And I think that one of the most important things that you can do is find a strategy that's going to work with your psychology, work with your schedule. And there's a very good reason for this, and it's just that I think that when you try to tweak yourself in order to accommodate a strategy, then you set yourself up to fail. And this can be as simple as saying, do I want to trade the whole session, or do I only want to trade part of the session? And the reason that I consider this important is that, you know, I've got strategies that are definitely based on trading the entire day. I've got strategies that are first hour strategies, and I've got traders who follow these things religiously and swear that, you know, the trading plan, which is essentially a whole trading session kind of a setup, is the only way to go. I've got other guys who like the first hour stuff more than they like anything else, and they do well with it. The guys who wind up having a hard time with all of this are the ones trying to pound the square peg into the round hole. So if you have a psychology that, let's say, has easy frustration, or that you don't like to sit in front of the screen all day, you get bored, you start fidgeting, you start looking at other things, it's just not your thing, then trading the whole session doesn't make sense for you. If you have a predisposition to wanting your work to fit your schedule rather than your schedule fitting the work, then trading part of the session can be the way to go. It's the guys who try to make this work because they find one of them to be sort of sexier than the other in terms of how it fits into their self-perception. Those are the guys who have a difficulty with it. But so that's just sort of the first decision you need to make is, do I want to trade all day or do I want to trade part of the day? Also, you've got the question of whether you're going to trade from patterns. If you're going to use chart patterns, then typically what you're looking for are things that sort of happen over a longer time period, right? So it fits more into the trade the whole day kind of a thing. You can also automate a lot of stuff. In all fairness, I have to say that even the whole session trades that I do are set up to go off automatically and have the software handle them, so you don't have to be tied to the computer all day. But still, these are good things to think about, right? And when you're trading from patterns, the other thing is you've got wider profit objectives. So how comfortable are you sitting around and waiting for something to make it to your target versus trading from momentum, right? So I've got this thing that I call the Nasdaq scalper service that I put out and like to trade myself. And that focuses on little tiny moves in Apple. So you're in, you're out, you're in, you're out, you're in, you're out. And always what you're doing is taking 20, 30, 40 cents. And those narrow little profit objectives happen in shorter time frames. And you're sort of a micro trader then. So you've got maybe 5 minutes in the market before your money's pulled back out again. And then you have to sit and wait for the next opportunity, for the next momentum move. So some people might say, well, what if I want to trade the momentum and have the wider profit objectives? I'm going to say that, one of the big things that can go wrong for traders is they don't have realistic targets. They don't have realistic stops. They set their targets based on how much they'd like to make. They set their stops based on how much they're willing to lose. And the market really doesn't care about either one of those things. The market doesn't care how much you want to make. Market doesn't care how much you're willing to lose. The market is just going to move a stock so much, and the way that it typically moves is the way it's typically going to move. So if you are trading Apple and you want to do scalp trades where you're in and out, then expecting more than a 20 to 30 cent move on any one of those swings can be very unrealistic and can land you in a bad situation. You can wind up with a lot of stop outs because it tends to get into ranges, and once it's in those ranges, it's a 20 center just about every time that it triggers. And then, of course, there will be the one that goes and breaks out and makes a 40 or a 50 cent move. And if your head's not in the right place, if you're not realistic about all this stuff, then you'll expect that 40 or 50 cent move the next time rather than setting a target that makes sense for what the stock typically does. The other thing is, with any of these strategies, you have to allocate your capital realistically. You have to make sure that you're not in, let's say you're trading the whole session from patterns and you have a trading plan that has, you've got 8 possible trades for tomorrow on it. If you don't go through and figure out how to adjust your position sizing, say that you just want to trade 1,000 shares every time you put on a position and you've got $40,000 in your account. Well, if you've got 8 setups for the next day and they start triggering first thing in the morning and you just go and lay on 1,000 shares on each one, and each one of these things is $30, let's say, you're going to run out of money in a hurry. And I want to bet you that the trades you wind up not being able to take wind up being the trades that go to your profit targets. It's just always that way. It's always a very psychologically defeating thing when you don't make sure that you can take all of the positions that you planned when you diversified your trading plan. So proper capital allocation, and then of course proper risk management. You want to make sure that your risk is being put in place because of something logical, because you found support and resistance on a chart. You see that there's reason to believe that if price gets somewhere, it's likely to take off and go against you. And when you go and manage your risk, then you want to make sure that you accommodate the dollar amount of risk that you are willing to accept by changing your share size, not by changing your stop, right? Because again, the market really doesn't care how much you're willing to lose. So with that being said, let's go and dig in to, I'm going to say this is my favorite pattern entry. It can be a whole session trade. It also can be a part of the session trade. When it's a part of the session trade, I typically trade it from support and resistance, so we'll go over that a little bit later. When it's a whole session kind of a setup, it can be a whole session setup, right? It doesn't necessarily mean that it will last the whole session. You just have to be prepared for the fact that it can go from 9:30 in the morning until 4 in the afternoon before it hits your objective or hits a stop, or maybe it doesn't hit either one. It just floats around in the middle. But this one can take more of the day if you're trading it by the plan, or it can be set up as a momentum trade if you trade it inside the parameters of the plan. And I'll show you what all that means in a few minutes. All right, so let's get right into it. Like I said, this is one of my favorite setups probably ever. This is something I call the fastball expansion of range and volume. And this one is really about following institutional footprints as the institutions are moving through the markets, right? Because as a big buyer or a big seller tries to get an order done, it creates this pattern that we're going to be looking at. And at some point during all that buying, what you'll see is an exhaustion of the liquidity that's available in the market. And that's really where our opportunity lies. We are looking for a continuation move the following session. So this is going to be a daily pattern, and then we're going to do our trade intraday. We're looking for some telltale signs that big buying or big selling is hitting a stock, and then making the decision about whether or not to try to jump on board of the coattails of that institution the following session and see if we can't get taken along and grab a little bit of the profit potential, or as big a chunk as we can of the profit potential of that institutional pressure. This pattern works. This pattern has predictive validity because of two things that go on. First and foremost, buyers or sellers are pushing a stock into the extreme widest range of the bar going into the close. And second, the buying or selling pressure comes back in just beyond that extreme the following trading day. Now, as far as what it provides in terms of results over time, we can just look at 2016 and 2017. You've all got access to the spreadsheets of every single planned trade going all the way back to 2006. That's for the core portion of the around the horn plan. That's none of the discretionary stuff. That's just those trades that could just be fully automated and traded by a machine. So there's no discretion whatsoever on those. And you can see here that in 2016, which was a slow year overall for the trading plan, if you look at the section there called fastball, in terms of profitability, 15.13 points per share were generated by that pattern over the course of the year. And that's pretty significant. I mean, fastball is a runaway favorite with most people because no matter how much they know about trading, this one is very easy to wrap your head around. And then it also happens to be a pattern that generates very, very consistent results over time. When it's planned and it triggers, it tends to have a lot of trades that wind up going in the direction you thought they were going to go, and it winds up being a trade that hits a lot of those targets that you establish. So 2016, again, that was a slow year. There's an election year, so we don't generate as many setups usually around a presidential election, not to mention the ranges on these things were a little bit lower because the anticipation was that we were going to wind up with a president who was going to represent a zero policy change in Washington, And what we wound up with instead was someone who was very, very different and introduced a lot of unknowns into the market. Market does not like unknowns necessarily, but has responded well to this person. The volatility is definitely back, and you can see that in 2017, the fastball pattern through the month of August has generated 10.68 points, and that the core portion of the trading plan here is actually generating as much in terms of potential profits through the month of August as it did for the entire year last year. So it's been interesting. And this doesn't count any of the stocks to watch, the scalper stuff, the radar stuff, all those other trades that we do, the opening gaps that we're going to get into in the next session. None of that is factored into this. This is just those 3 or 4 around the horn trades that are presented every day, and how do those very, very replicable trades perform over the course of a year. So now let's go, and you've got this color of how this thing does, and you sort of have the background on what it is that we're looking for. There's more to it than just the institution, but the most important things I think have been presented so far. Let's go and just pull apart how this move is put together, and then look at an example. We'll look on the short side because that's been what's coming up for the last couple of weeks. Have been some short sales on this. And if you're interested in learning the whole thing, if you want to go and take the course, we'll talk about that at the end. You have the course that's available, and some of the add-ons and everything that are being offered today as a special for the incentive with today's seminar. But the fastball expansion of range and volume, you're looking for days where you've got a really wide bar, the widest range of the past 10 trading sessions. You get about 2 weeks worth of data. Well, you've got exactly 2 weeks worth of data, right? And you're just looking at this and you're saying, I want to know that I've got the widest bar of the past 10 sessions, and I want to see volume that's higher than average over those 10 sessions. And then again, we're talking about the short side entry here. So we're going to want to see a move lower, and essentially what you want is the open to be in the top 25% of the bar and the close to be in the bottom 25% of the bar. You don't want to see that open or closing tick happen in the middle of the bar somewhere. And then the following day, we've got a short sale entry, going to put that 10 cents below that expansion day low. We target underlying support from a daily chart. So the pattern presents on a daily chart, and we look for our support on the daily chart as well. That's where we're going to target. And then we use intraday resistance to establish a stop overhead. So this is just the way I've always done it. It's the easiest way to reckon with what's going to happen the following session. Daily support and resistance, that's your target. Intraday support and resistance, the time frame you're actually going to be trading in, is going to be where you establish your stop losses. There's a couple different types of fastball expansion moves. I'm going to focus, like I said, on the short side of the market. I'm also going to focus on a pullback move because that's what we've been seeing lately. So that's what all the examples are. In this case, you see you've got a trending move to the downside. That's followed by a pullback to the upside. And then you get this expansion of range, expansion of volume bar. And again, you're looking at daily bars here. It opened at the top, it closed at the bottom. So we're going to look to short the stock 10 cents below the low of the bar that created the setup. So for this first example, let's just look at the most structured entry type. So this is HCN, and we're going to look at how the trade's set up, how it's planned, and then how it's carried out the next day. So here's a daily chart. And on the daily chart, you can see we've got a wide range bar. And that wide range bar comes on the heels of a pullback, right? The stock started moving lower, then it pulled back up higher again. And we can see there's a volume expansion as well. Volume's building. And there is price support down below, right? So we've got a place that we can target in terms of this is where we think it's going to go. And we've got a valid setup, and then this is not finished. So we have to figure out if the rest of the plan is going to come together before we know if we have a trade, because we need to get a stop loss in place yet. The stop is going to come from an intraday chart. And we're going to look at this. These are 5-minute bars. I always trade for 5-minute bars. And here what you can see is how the setup is validated and where we find our stop loss. So the validity in this thing, we see that we have got selling pressure going into the closing bell. I like to see this, especially accompanied by big volume and by support and resistance. So we see that there is support and resistance here. And to me, what that's saying is if it gets up above that line, it's going to travel back up into the range. That's going to be a really good place for me to put my stop loss. And the fact that there's all this volume going into the closing bell tells me, first off, institutional pressure. Second off, in order to get up above those bars, it's going to have to really undo a lot of that activity. And if it gets back up into this bottom range down here, then it's very likely it's going to run into the same selling pressure again. So we're betting that as this was selling off, whoever was doing that selling wasn't able to get done what they needed to get done, and that the following day we've got the opportunity, like I said, to hop on their coattails and go for part of the ride on the way down to that support that we just identified on the daily chart. Now here is my trading plan for this one. This is just how I put it together. I've done it this way forever, and it works for me. You know, it might be too much specificity for some of you, but you know, you just put something together the way that that you need it to be done. A lot of people have subscribed to this over the years. It's been tweaked a little bit due to the input that people have given me. You know, when I consider it useful, I go ahead and include it. So the support and resistance levels and the confluence level, that's relatively new to this. That's based on a lot of input and feedback that I've had from the guys who attend my income trading boot camp. So they have a lot of access to me and spend a lot of time talking to me. And one of the things that they've said was it's hard sometimes, or it's harder than I might think it is, to find support and resistance. When you've been looking at something for 20 years, it seems second nature. And they said, well, it'd help if you added those support and resistance levels to the plan. So we did, and I think it wound up being a good change. But here we see that in Welltower Incorporated, this is HCN. We've got a fastball. It's a short setup. 72.92 is the entry. 73.24 was the stop. That was from that 5-minute chart. The initial target was $72.41. Remember, we got that from the daily chart. We can see that our profit to loss ratio is 1.59 to 1. We stand to make $1.59 per share versus every dollar that we stand to lose per share. 50% of the target is $72.67. And what that does for me is tells me when we move from 72.92 down to 72.67, going to tell the machine to move the stop to break even. And as a matter of fact, there's another money management rule. When it gets to 72.51, the stop is going to get moved to 72.67 to lock in part of the profit. My approach to this stuff is very methodical and very rule-based. It's very simple as well. There's only 3 rules, really, and most of this stuff can be carried out by the machine. But let's see how this one actually played out. When it's time to actually trade this plan, we can see that on the chart here, I've got 72.92. That's the planned short sale entry. So I'm going to short at 72.92. And then I've got a stop up at $73.24. And you can see my target's $72.41. And on this example, you know, what I'd like to point out is you can go through and look at all these spreadsheets from all the years. And what I want you to notice is how often we are dead on in picking the profit target. And look at them going forward too, you know. So, I mean, I don't have the benefit of hindsight. When I put those plans up, those plans are just up. And they're always up today for tomorrow. So we don't have any look back. There's no hocus pocus going on. These are the plans are published for guys who subscribe to it at about 2 o'clock Pacific time every day. So at 5 p.m. Eastern. And you'll see that on these ones that hit the profit targets, it's most frequently the case that the stock turns around right at the profit target. And the reason I'm telling you that, I'm not blowing my own horn, I'm trying to emphasize the importance of understanding support and resistance and how to shift those time frames so that you can go out and look at it on the daily chart and say, here is the thing that's going to turn this baby around when it hits this number, and I'm going to be ready for that. That's a big pocket of liquidity. The stock made this giant move because it lost liquidity. Now when it goes and it finds it again, that's going to be the end of the move, or the end, unless there's a ton to unload in this case, but I don't want to be there to find out. I want to have my profit objective met and be done with the trade. So that is the textbook version of the trade. So if you go to Around the Horn, a trader's guide to consistently scoring in the markets, this is what I wrote about in that book. This is the original version of the trade. Now, since then, lots of things have changed. Volatility's changed, for one thing. We started working with this stuff in 1997. We were trading in fractions. They moved the market to decimalization some years ago. That changed a lot of the volatility, made it harder to get big swing moves. Quite frankly, it's not the great thing that everybody thinks it is. I think everybody wants to see spreads of a penny, and in my world, in my thinking, I miss having eighth of a point spreads. Eighth of a point, for those of you who don't know, is 12 cents. So we used to have 12-cent spreads, 25-cent spreads, and everybody was able to work in that environment, and I think that it was actually easier to trade that way. Things have shifted, so now there's a need for some additional entry opportunities, and one of those is the support and resistance timing that I've got on the trading plan. So you can go through and use the support and resistance levels that I've identified, or you can do them in your own trading, and you can find alternate entries to get you in and out of a stock. In this case, we've got another one of these setups where we've got the wide range bar. That's your fastball expansion of range and volume. You can see the volume is nice on this one. It's a nice big bar. And then you can also see what stopped that move dead in its tracks, right? So a couple minutes ago, I was talking to you about when a stock hits support and resistance, what I expect that to be is a pool of liquidity. And once it hits that pool of liquidity, there's going to be a ton of transactions going off there. And only if it manages to break through there and get down to that next support and resistance level, right? This one here on these highs, that's the only way that we're going to see an extension of the move that happens into the support and resistance. So right now, I'm not at all surprised that it stopped where it did, because it landed right on this liquidity pool here. And I'm expecting that the next place it's going to go is down here, right around 96.09, where we have these support levels and this resistance. And once you've seen this happen, you just always assume there's still bodies buried there and that that's where we're going next. Here's our intraday chart on this one. So now you're looking at a 5-minute chart, and what you see is selling pressure, pushing the stock lower. We've got very obvious big volume going into the close, and we also can see there's significant resistance overhead. But would we really put our stop loss all the way up here? Right? So think about this, because it's easy to just see this support and resistance up here and say this is very, very big resistance overhead, and it's not going to get up through there. But then look at this, right? $96.81 is the close. That support and resistance line that we just drew is up around 98.25. Right? Nobody's going to risk that much on a trade, especially if we can find better resistance in the big move going into the closing bell. The stop that I liked on this one, $97.16. So down here. Now that's much more acceptable. It still gets you through basically 2 levels of price activity, right, that you have to move back up through. And then if you do get up through that, well, then you're going to expect that it's probably going to come up here and test this, but I don't want to be part of that move. But the other thing that I can see based on these varying levels of support and resistance over the course of the session is I've got an opportunity, if it comes back up into here again, to short the stock, because it had one heck of a time trying to get above there, couldn't do it. So I've got another opportunity inside my trade at several levels to put on a short side trade and look for this move back down into the tail. Again, we go through a bunch of different ways that this trade is set up in the course. And, you know, if some of you I know are coming to our next boot camp, some of you are just taking the Income Trading Academy module on fastball because you like this pattern, but pay real close attention to the variations, because these variations are really the things that are going to make this a very interesting trade for you. Let's look at the trading plan for this one and just see how it was set up. over on those support and resistance levels, you can see that 97.40 area is a significant support and resistance level that I've outlined on the trading plan here. You can also see that at around $98.16, we're going to see the floor trader pivot for the following day, and that also is very, very close to the 98.13 level. And if you do the math, if you're a Fibonacci person, then you're going to see as well that the 50% fib retracement is going to be right there at $98.16. Now, how do I know that? Because anytime a stock makes a fastball expansion move, opens at the extreme and closes at the extreme, the 50% Fibonacci ratio is going to be identical to that floor trader pivot, because the floor trader pivot is going to be the high plus the low plus the close divided by 3, which is then going to overlap with that 50% retracement. Some of the other patterns, it's not as clear as this, and definitely if the bar doesn't open perfectly in the extreme and close in the extreme, it's not going to be like that. But in this case, it most certainly is. Now, here's the chart, the intraday chart of the trade day, and look what happened. Here was our planned entry. Here was our stop loss. Here was our target. And here was our support and resistance level. So we'll get back into the planned portion of it in a second, but look what happened. The stock opened and then shot up to that prior resistance and went down through our planned entry level and down to the target. So if you took that trade through the resistance on the way back down again, it added 69 cents per share to the profitability that you were expecting on this move. By anticipating what the most likely flow in price was going to be, you just potentially managed to put yourself in front of a bunch of additional opportunity. So it pays to stay frosty, and you definitely don't want to just start doing this tomorrow, right? You want to go through and look at just a lot of charts and make sure that you're properly identifying where the significant stuff is. It's very easy to just start splaying lines all over the place and thinking you're seeing something when in reality you're not seeing anything. But if you do the homework and you look at these things, or just look at the trading plan every night, a lot of you are subscribing to this, and if you're a subscriber to the Around the Horn plan, look at those numbers every day and go and drill back into the chart and look at it for yourself and say, well, gee, where did he come up with these from? Why are these the values that were selected for today's trading? Do I see them the same way? If yes, why? If no, why? It's important to really have an understanding of the intraday dynamics on these things. Because like I said, it's very nice to carry out the trade by the plan. It's even nicer, to get this big move from your intraday support and resistance. Now, if that's a handful, let's go back and consider that confluence trade that I was talking about, because that's one that you can find very easily, I'm going to say, because that central pivot line is going to be an overlap, as I said. So what you can do is just look for the central pivot initially, then go and look at the bar, make sure it opened at the high, closed at the low on the fastball, and then if you've got this expansion of range and volume in place, opened high, closed low, you know that fib number is going to overlap, then all you have to do is look at that central pivot value and go back to the intraday chart and say, was there also support and resistance right there? And until you get good at eyeballing where those plateaus are inside the trading day, it gives you a little cheat that gives you the opportunity to go back and find these things a little bit easier. But here it is. Here's EGN. This is Energen, and what we see here on the daily chart, big wide range bar, nice expansion of volume. We've got prior support right down here. Gives us a very easy setup in terms of figuring out what we're going to do with our trading plan. Now we look at the intraday chart. So on the intraday chart, we can see a bunch of stuff about this day in particular. We had a big move down early in the session. That's pretty typical that we get they're going to try to get something done, and they're going to try to get it done early. And then this is going to happen over the course of the day where you just get this sort of lunchtime dribble going sideways, but the slope of the thing keeps moving to the downside over the course of the day. And what we see is selling pressure as we head into the close. So going into the closing bell, we've got big volume, and we've got a big move that's continuing from $48.40. In this case, we're moving down into $47.80 or so per share. And we've got support and resistance right here. This is, to me, the most clearly identifiable stop range because we've got support and resistance there. And if it moves back up above that, I'm going to anticipate a move up into the $48.40 area, or maybe even all the way up into $48.70 or so. So if I'm going to be wrong, I'm not going to stay wrong. I'm going to get out of this thing and move on to the next opportunity, or watch for a second entry opportunity on this one. Now let's look at the trading plan. Our support and resistance levels are bunched up on this one, and it does give us confluence around that $48.55 mark. So we've got a fib retracement to 50% that's going to happen right at $48.55, and then we have support and resistance levels that aggregate right in that same area. So in terms of how we're going to handle this the following session, if it were to trigger and we were to take it, fastball, expansion of range and volume, short side setup, $47.70 on the entry. That's 10 cents below the low of that bar. The stop loss can be $48.06. Again, that comes from the 5-minute chart. Right? We identified that level as being the one that to us looked most significant. Our initial target from the daily chart is going to be $47.25. Gives us a ratio of 1.25 to 1 on the position. 50% to the target, $47.48. If it gets there, we're going to move the stop to break even. So this all should be lining up for you right now, right? So things are set to go the following session. We know exactly what we're going to do in terms of getting the trade to risk-free, getting the money management in place, and we know where we're going to get out if things go wrong. And not everything comes up roses all the time. So here we've got the trade as it happened. And you can see that this thing came down, hit that planned entry line once for 36-cent loss, and then unfortunately came down and hit it again for 36-cent loss. Now you got a 72-cent loss for the day on this trade. That's not going to be a happy thing for anybody. But look what happened. By having this additional entry point, this additional idea here at $48.54, what did that do for us? Well, first off, if you're following the around the horn stuff, even if you missed the 48.54 entry on the confluence reversal, look here, what's this? This is called an infield fly setup. The infield fly is a tell that the market's about to move lower in a stock. It hits the line, assuming you got the trade off at $48.54, and then you let this move. Over the course of the session, you made it down to $47.25. Now you've got a $1.29 move in your favor, and what that does for you is wipes out that loss and turns the trade into something that's potentially profitable instead of something that potentially generated a stop out 2 times. So again, how do you handle it? You just have to anticipate that something's going to happen. So you've got your levels the way that you think things are going to go, but if they don't go that way, then you look and you say, I've got prior resistance. I identified it on my trading plan. I'm going to have a very, very tight stop above that pivot line. If it doesn't reverse right away and come moving back down again, then I'm just going to figure that it's not going to make this move. But once it does, it actually gets me down through that planned entry line again, and this time things wind up playing out over the course of the session the way that we thought they would. So not everything goes exactly the way you think it's going to happen initially, but then you've got the rest of the session to look at these things and say, look, I know what happened yesterday. I know why it happened. I know what's going on today. As you look out here on the right side of the chart, when you see your volume by price, you can see where the inflection reversal happened, and you can see exactly where the volume spikes were and why things were happening. But that's a whole topic for a whole nother kind of a lesson. But for now, just bear all this stuff in mind, and just remember, this is really a solid setup. This is an easy setup to wrap your head around. There's a bunch of additional things that go into it, and if you're interested in that, if you're interested in really developing an expertise in the expansion of range and volume, then you can take advantage of the seminar special. So the seminar special is a fantastic deal. It bundles a bunch of things into what used to be just one product, or what is always just one product, that being that Income Trading Academy module on the fastball strategy. So now the fastball module will also have the introductory module and the psychology session included with it. That's already given you a nice bundle of stuff. And if you later decide that you want to buy the entire Income Trading Academy, which everyone who has ever bought just this module has done, then what we'll do, of course, is apply the purchase price here to the purchase price of the bigger package of education. But that's not all we're going to do. So I think there's a bunch of stuff that's going to make this much more approachable and much more useful for you. First and foremost, we're going to include a month of the first hour trading pit, where you can get in there with guys who have actually been to boot camp and watch them approach these trades and listen to what they're talking about. And it's moderated by a guy who's been to boot camp. He's not being paid to be in there. He's one of my star students. They like having this room to interact in, and they like having folks come through and sort of see what they're doing. So normally that's another $200 worth of education you're getting there, because you're coming into that first hour trading pit. It's really a group mentoring kind of a situation where everybody is really benefiting from everybody else being there. I'm there. My wife Julie's in there. We've got Rick Kipp in there. We've got another one of the first students I trained many years ago, so 5 or 6 years ago actually, and he's in there most of the time. And then there's just a bunch of great folks who have been to the boot camps over the last 6 years. We're also going to include the pattern scans for either TradeStation or Metastock. So normally those sell for $299. So if you've already bought them, you can let us know, and we'll make the adjustment. Right? I don't want somebody feeling like they're not getting everything that someone else is getting. But you can take your pick. If you don't have TradeStation, you have Metastock, you take the Metastock one. If you don't have Metastock, you have TradeStation, you take TradeStation. And if you don't have either one, what we'll give you is a 1-year membership to an online fastball XRV scanner, expansion range and volume scanner at traderinsight.com. So you can come in there every single day and get all these expansion, range, and volume setups. You get them for a full year. Either one of these three options is another $299 product added to the bundle. So I just really want to make sure that, if somebody's coming in and you're taking the course, that we're giving you enough that you can take this stuff and apply it, and hopefully find some profit opportunities in the market, and have some hand-holding going on, and have some help finding the patterns every day as they set up. I flip through about 1,000 charts every night. That's how I find these myself. I'm eyeballing these things. I'm looking for them. Makes it a lot easier to go through and have somebody else scan for them. And what's also nice about it is you take the course, you take the module, and then you try to find them yourself. Then you run a scan, or you go to the site and you look and you compare notes. You see, okay, well, what are the ones that I found look like compared to the ones that the scanner found? And then when you come into the room, each and every morning, you're going to see these guys talking about the setups that they found, and also they're going to be trading the trading plan live then every single day. So the trading plan that I've got put together, they're going to be going through those and finding those inflection points and working with them in the room. So it's a fun package. It's a fun place to be every day. I think you're going to like the people there, and I know you're going to like the course. I know you're going to like the education. So if you're ready to take the next step and become a better trader, then click on the special offer icon that just popped up in the top right corner of your screen. You're going to save 60%. You're going to be very happy with your purchase, and I am really looking forward to working with you personally in the first hour trading pit. If the offer vanishes at any time, you can always get it back by hovering your mouse over the top right corner of the video. And what I'd like to do now is take a break so that everyone can stretch, get a cup of coffee, chew on that special offer for a few minutes, and when we come back, we're going to talk about my best first hour strategy. This one is a statistical manipulation of market data that can get a trader on the right side of an opening gap reversal just before an explosive move. I call the setup Baltimore chop. It's another baseball metaphor, and if you're not a baseball fan now, you probably will be after you learn this bread and butter strategy. It's one of my favorites, and all of my students over the years have loved working with the setup. So let's take that break, and remember, if you want to see the special offer details, just click in the top right corner of your screen. Now let's get into what I am certain is going to be one of your favorite trading strategies ever once you wrap your head around it. I call this Baltimore chop. This is an opening gap trade that looks to use a statistical manipulation of what's going on with some market data to figure out when there's a very high probability of a reversion back into the trading range. Now, when we're trading gaps, I call the setup Baltimore chop, and the reason for this is going to become clear in just a little bit. But for those of you who just want to satisfy your curiosity, Baltimore chop was an old Baltimore Orioles batting trick that really was designed, I guess, to get a slow runner on base. And what would happen is that the pitcher would throw the ball, and the batter would spike it down into the ground and then pop it up over the pitcher's head. That allowed the batter to get to first base before anyone could field the ball, and I'd like you to just keep that in mind as we go over how this pattern sets up, and I think you'll see why I thought this was a good metaphor for this particular opening gap trade. There's a couple things we have to understand when we look at this one. If you want to know the mechanics behind it, then pay close attention. If the mechanics really don't matter to you, then you can just tune out for a second. But I think it's great to know what it is that's being calculated whenever something is going to help me with a decision. First off, there is range and true range. Stock's range today, I think everybody knows what this means. It's just the high minus the low. So if we have a bar, this is your high price, subtract the low price, and if the high was $50.10, the low was $49.40, then what we have is a 70-cent range on the session. Now, true range is a little bit different. The true range is the greater value of the range, the high minus low, or the absolute value high minus the previous close, or the absolute value low minus the previous close. So what we're looking for in the instance of true range is the range including any gaps that occur on the daily chart. So here we have a bar. This is a daily bar again. And we've got the high price. Then we subtract from that the closing price of the previous day, and this gives us a bit of a different picture. So if the high price was $50.10 and the close of the previous day was $49, then the true range was $1.10 for the day. When we're calculating the opening gap requirement for the Baltimore chop, we have some assumptions. And these assumptions have to be agreed to, or you really can't rely on the calculation. So let me just go over these. First off, we have to have a normal distribution. So the data has to be normally distributed. And in the case of stock market data, it almost always is normally distributed. The next assumption is that true range is a proxy for volatility. Now, I've done a bunch of work on this over the years, and I can tell you that true range is a very good proxy for volatility, at least in the work that I've done, and has panned out very nicely when used as a volatility measure for this opening gap scan. Finally, we have to assume that volatility is mean reverting. What those three assumptions give us is access to this thing right here. This is a standard normal distribution. Statistically speaking, in the standard normal distribution, if you go one standard deviation on either side of the mean, once you're out there, 68.2% chance you're going to have a mean reversion. That accounts for what you're going to expect to see in this red zone. It's the bulk of the distribution. What we're interested in is moving out into these purple zones. If you add these to the mix, now you're out two standard deviations, and you've got a 95% probability that you're going to have a reversion to the mean. That doesn't mean you're going to get all the way back to that average. It just means you're going to start moving in that general direction. And if we believe in the statistical phenomenon known as mean reversion, then what we also believe is going to happen is that when we get out into periods of high volatility, so these red balloons here are high volatility areas, we are going to be looking for a move back towards that arithmetic mean in what's called mean reversion, and that's where we find our profit potential. The formula that we're using to calculate how far we are from the arithmetic mean, standard deviation equals, you take 10 samples in this case, x minus the average, so 10 true ranges minus the average true range. We square that to get rid of any negative values. We divide it by 10, the number of observations. We take the square root to get rid of that square. That's one standard deviation. This is a very simple SD formula, and it's the one that most of the software is going to be using to calculate this. Some software might use n minus 1 as that bottom value. Here's what it looks like in terms of figuring out whether a gap is going to have the proper amount of move to get us 2 standard deviations away from the average and thus give us the opportunity to try and fade the gap move. We've got 10 days worth of true range data in this left column, and what the software is going to do is take that and plug it into this formula to derive the values that we need for our calculation. So we've got x 1 through 10, those are those 10 values. We've got the average, which is 1.25. That's just the average of day 1 through day 10. We have n, which is just the count, which is 10 samples. And then when we go and run the formula, what we find out is the standard deviation is 49 cents. So we're going to multiply that by 2. 2 standard deviations would be 98 cents. You would add then 98 to your average. What that tells you is you'd need a $2.23 gap in whatever this particular stock would have been in order to have a potential gap fade for the morning's trading. The rules for this are very simple. Once you get these qualified as 2SD Baltimore chop gaps, bulls or bears, gapped it open, 2SD above or below the close of yesterday's daily bar, and we're just going to enter just above the high or below the low of the deepest bar in the gap. Now think back for a second to our Baltimore chop picture and then consider what's going on here. These are 5-minute bars now. So on a 5-minute time frame, you have got a move up into a close the prior session, and then you've got a gap to the downside that represents a 2SD gap, and we're going to look for the deepest high since this is a gap lower. So as each bar moves lower, we're just going to keep moving our entry down. And when we finally get the deepest bar in this move, we're going to look to enter just above the high of that bar in the next 5-minute bar of trading. And we're going to target something significant in the first bar, either the high, the low, the open, the close. Those are all the areas that we're going to look to find significant volume and the opportunity for a profit objective. So why does that look like the Baltimore chop to me? Well, if the ball is hit by the batter and spiked down, we are looking for the point at which it's likely to spike higher, and that's where we're looking to run. The best setups happen on earnings announcements. They tend to occur very frequently during earnings season, and my guys are always very excited when we have Baltimore chop trading opportunities in the morning in the first hour trading pit. This is definitely a first hour trade. We don't ever even consider entering one of these Baltimore chop setups after the first half hour of trading is over with, but we'll take it right up until the 10 o'clock hour Eastern time and manage the trades through the first hour of trading if it's necessary. But the reality is, since we're never really entering this after the first half hour is over, usually first half hour is when we're done with this one. Here's an example. This is Seagate. This was a long entry on some bad earnings news. You've got Seagate Technologies. This is the daily chart on this one. Look at that gap to the downside. We had a big move. Looks like it's almost a 20% gap. The news on this one, Seagate Technology, STX, down 17.2%. It's right there in the red box. We're alerted to these a number of ways. I'll look at the news feeds before the market, And what I'll do then is, in some instances, I will just plug these into the spreadsheet-based gap scanners, which are for Realtic and Metastock. Those are going to consider the gaps that we give it. In TradeStation, we just load up the entire S&P 500 and have Radar Screen run the gap scanner, and it will sort to the top any stock in the S&P 500 that gave us a gap. So there's a little bit of a difference in how the scanners implement the data analysis, but other than that, we're talking about the same thing in each piece of software. The calculation is always that first standard deviation calculation that I showed you. Figure out what's 2 standard deviations, add it to the average of true range, and if the stock gap that much, then we are good to go. Now here's Seagate on the trade day. We can see that in the second bar of trading, I usually like to wait for at least the second bar. The entry level is going to be a violation of the deepest high price here. So the high price of the second bar of trading represents the violation that we're looking for in order to get long this stock. After I get finished talking here, I know somebody's going to say to me, how do you know which one's going to be the deepest high in this opening gap? Well, you don't. You're always just moving your bars around, and there's order entry finesse that we can talk about in another seminar in terms of having a bracket order that's live and then just moving the lines on the chart around to move the bracket. But realistically, there's plenty of time to consider what you're going to do as each one of these bars form. The second bar right now is the deepest bar in this pullback or in this opening gap. The initial target is going to be the high of the first bar of trading. And our stop loss right now is going to be below the significant low of the morning. So in this first 10 minutes of trading, the reward to risk ratio would be a little bit out of whack and would prevent me from taking a trade if the third bar was going to come and trigger that entry. But it doesn't. What it does instead is form a new low and a new lower high. So now our entry is a violation of this bar, and our stop is below the low of that same bar. And now look at my reward to risk. Everything makes sense. And once we have the entry, the move from $32.21 to $33.44 winds up being a pretty reasonable profit objective. That's because these are, generally speaking, very violent moves. They tend to find an inflection point and then just turn around and run. It's not uncommon. If you got to the profit target and wanted to see about booking a profit extension, then typically what I do is a fib study, peak to trough of the first wave of the move, and we see here that a 34.05 target plays out from that Fibonacci extension. I've got to say, however, I generally have got these things bracketed up, and if I'm in a Baltimore chop trade, it's going to wind up taking me out at that initial profit target or at the stop. I'm not really going to have time to jockey those around once I'm in the position. Now let's look at a short side entry. This is Aetna, and again, we're focusing on earnings news. An earnings surprise in either direction is generally going to be met with an overreaction. That's the theory here. And we really don't want to trade these on some sort of life-changing event that happens to a company. If a CEO or a CFO or somebody winds up in prison and all the company's money is gone, that's not a time to fade the gap. That's a time to trade the gap. When we get an earnings gap or another business as usual kind of an event that drives price, however, we've got a really good opportunity to fade these things. Here is the gap in Aetna. You can see on the daily chart, it moved way higher right on that opening bell. The company had reported second quarter adjusted EPS of $3.42 against consensus of $2.35, and quarter two revenue of $15.49 billion versus the consensus $15.39 billion. So something's off there. But when we go and look at this chart intraday, it all makes perfect sense. We have got an entry level, in this case below the low of the deepest bar in our morning move. We're going to look for a violation of the highest low price. So if the stock gaps up, you're going to be watching that bottom tail of the bar. Our initial target is going to be right at the low of the morning trading. The low price of the second bar is already below the closing price of that first bar, so we're not going to target a close. The open is up at the top of the bar. This one started sinking right away, so we're not going to target the open. The next most significant level of price activity was at the low of the first bar of trading. Our stop loss is going to be above a high volume threshold. So if you look over on the right side of the chart, you can see our volume by price data. This makes for a really decent stop loss on this. I'm not confident of putting it just over the high of that entry bar of that second bar of trading, primarily because the tail of the first bar was up as high as it was. So I just want to look for a significant level of price activity. And if it hits there, I just assume that AET is going to take off in the wrong direction, and I don't want to be part of that move. We see that bar 3 did hit our 159.98 entry price, and 159.06 was an easy to achieve target, plowed right down through it. And we see again that a fib study drawn peak to trough on that first bar of trading gave us a very good representation of where price was going to go. 157.84 made for a nice extension on this, but again, this all depends on how much time you're going to spend glued to this one symbol. I like very much the practice of bracketing something up and moving on to the next thing, just letting a trade sort of handle itself. But if you are looking for the extensions, my recommendation is to format your Fibonacci study with a 382, a 50, and a 618, and then a 1.382, 1.5, and 1.618. Those are the only values that I use in the Fibonacci studies that I plot for these opening gaps. Now, what if you're really patient? What if you're looking at this and you believe that it could very likely close the gap into yesterday's trading? I'm not a big proponent of trying to close gaps, but the next thing that I would definitely look at is something we talked about earlier. That's the floor trader pivots. I would target R2 on a move down and assume that if we got to R2, we might get a breakdown into R1, depending on how close R2 is to yesterday's trading data. So there's a bunch of stuff you can do. There's a bunch of ways you can manipulate these. I just kind of like them straight out of the box, but you might prefer to add some of these additional studies. It's all about what's right for you. It's all about what you're comfortable doing and how you're comfortable trading. Now, what about a big money stock? How are you going to handle a gap in something like Tesla? Tesla is trading at $350 a share this particular morning. We've got this gap to the upside. And the first thing that I heard from some of the guys in the first hour trading pit was, I don't think I want to trade a $350 stock as an opening gap. Now, my response is, take a look at what caused the gap. It's up after earnings. So realistically, this is just like any other gap that we deal with. If the $350 price tag is the concern, then my suggestion is just drop the share size. Drop the share size way down so that this represents the same profit potential and the same stop out potential as any other stock that I would be trading on any other day. Entry on this one, this was a gap higher, so we're looking for a violation of the highest low price. I'll look at the bottom of the bars to figure out where we're going to get into a short sale. As that moves up, we wind up in bar 3 of the morning. This 15 minutes into the trading session, we mark 349.96 as our potential entry. And once again, our initial target is going to be at the next significant thing that we see happening. That would be the open of the first bar of trading. Looking for a move 346.96 down to that opening tick. We're going to need a much better stop loss than something up around the high of the day. And what I like to do on these is look at the bar that causes the trigger. And what I would do on this is look at that second bar of trading and third bar of trading. I see that close, I see that open. That's going to be where I initially rest my stop. But on the fourth bar of trading, I've got a high there. Gives me a tighter stop at 347.70. So I'm going to use that. I'm going to treat that as if that's the entry bar. That's really the bar that's taken off. And when Tesla gets down to that 345.36 level, I'm going to start treating this as a scalper setup. And we're going to get into the scalper setups in the next session. But this is one of the stocks actually that we like to keep open all day long as a scalping candidate because it can really respect those lines. You can see sort of how it's playing out over the course of the day here, that it tends to trade in ranges. And that's really my next favorite trading setup, is just going in and pounding those ranges all day long and finding the places that price is going to inflect and using those to enter and exit the market. So you see down there in the corner, I just left up that trend line tool. That's how I'm drawing these lines. It's just the horizontal trend line tool in Realtick, and that makes it really simple for me to manage these trades. That same tool allows you to draw the Fibonacci studies. In this case, you did not get an extension down to 342.71. You can see that waiting for that fib extension would have wound up costing you money in this case. That's one of the reasons that I just like to play these pretty close to the vest, set up the bracket, and then let it take care of itself. So we've got a seminar special on this one as well, on the opening gap setups. $199. This is a really good deal. This gets you the ultimate guide, trading opening gaps. This is a lesson that goes through, really hits the points. Make sure that you understand the logic behind every one of the setups and where to place those entry orders and exit orders. And then you can pick either the scan for Metastock, which is going to return the values to Excel. You can have an Excel sheet open, and that Excel sheet will tell you what all the Baltimore chops are. Or you can select the Around the Horn Baltimore Chop scanner for TradeStation. That's going to work with radar screen. So you have to have radar screen in order for that to work. Or you can use the Around the Horn Baltimore Chop scanner for Realtick, which also works with Excel. Then the best part, we're going to include 2 months in the first hour trading pit where you can see these being scanned and the reaction then that the guys in the room are having to the various stocks that come up on the scanner on a given day, how they sort them, how they figure out which ones are going to be the best trading candidates. Rick Kipp is in there. This has been his bread and butter trade for the last 3 or 4 years. He's moderating that room. He does an excellent job. He makes sure that everybody understands exactly which one of these opening gap trades he's going to take. He's very careful to explain where the entry, the stop, and the target is before he gets into the position. And then he walks you through what he's doing the entire time that he's in the trade. This is going to be included for 2 months with the seminar special. So the Trading Opening Gaps course, that's normally $99. Either of those pieces of scanning software are usually $200, so we're at $299, and 2 months of the room is just about a $400 value, so that's almost $700 worth of materials for just about $200. It's a really great deal, and I know that if you are into trading opening gaps, you're really going to like the Baltimore Chop, and you're really going to like having access to the room and having a way to find these things that actually puts you in front of trading ideas that fit the statistical model. They're not just ordinary gaps. So this special is really for those of you who are looking for a first hour strategy that can just knock the cover off the ball. The actual value of the bundle is $693, so you're going to save 70% when you order the seminar special. The Baltimore Chop Gap Reversal, this is something that I've become very well known for over the years, and that's because traders love it as much as I do. It's really easy to work with, and once you nail it down, the potential for profit is really fantastic. If you're ready to take us up on this offer, then click on the special offer icon that just popped up in the top right corner of your screen. You're going to save that 70%, and the course will be available to you immediately. Then you can scan for the setups, or better yet, join Julie, me, Rick, and a room full of bootcamp alumni live in the first hour trading pit to see these setups play out real time during the first hour of the trading day. Again, if the offer vanishes, then just hover your mouse over the top right corner of the video and it'll pop right back up. Now, I think we're ready for another break. This time when we get back, we're going to talk about my Nasdaq Supercap scalping strategy. This one can be a first hour trade or an all-day affair. It's your choice, but I know that this is another strategy that you're going to be really happy to have in your repertoire. All right, let's take that break. All right, and now let's move on to the last one that we are going to cover today. This is what I consider to be just a really great trading strategy. I call it the Nasdaq Scalper, and what we're doing with this is trading Nasdaq Supercaps. This is outside my original wheelhouse. I used to focus exclusively on NYSE listed securities. I started doing the Nasdaq scalps about 5 years ago, put out a service around the trading plan that I was going to be using. Very, very popular. People like this idea quite a bit. They like the fact that it's structured scalping. And I'm going to show you more or less the basic way to set these up. There's some advanced techniques and things that we use that we're not going to get into here because that's a whole separate, probably 2-hour seminar. But you're going to get the idea when you see how the setups are structured as to what it is that we are doing with these each and every day. We trade these in the first hour trading pit quite a bit, and there are some prerequisites that you will want to keep in mind when you are using this strategy. The first is you want to select stocks with supercap liquidity. By this, I mean the Apples of the world. And when I first started doing this as a trading plan, I originally called it an apple a day. That's because Apple was on there almost every single day, and it still is. That thing trades enough shares that there is never a problem with the liquidity. The spreads are always very, very tight, even right off the opening bell. And the moves that it makes, 95% of the time, very, very easy to predict the type of range that it's going to be trading in. So that's the kind of stock that we're looking for when we are considering what to include in a supercap trading plan. I want to make sure that when the stock is trading in intraday ranges, this is what we're going to focus on here, is finding little ranges that the stock tends to trade in, that it's got at least 20 cents of motion within that range, because that's going to be our sweet spot, trying to pick off 20 cents at a time and doing it over and over again. For stocks with tight travel ranges, we're going to want to make sure that the spreads are really tight as well. So if you've got a stock that just has 20 to 25 cents in travel range on the typical volatility band that you're creating, I'm going to show you how I put those together in a second. You also want to make sure that those spreads then are not going to be more than 1 or 2 cents. You don't want to see a 10 or a 15 cent spread when your target is only 20 cents, because what will wind up happening is you're going to get in, and if you wind up taking liquidity on your entry, then you're going to wind up getting popped right back out when it trades against you. So be very conscious of how tight the bid-ask spread is. For opening trades, if you're going to trade these right off the opening bell, then I would suggest monitoring the pre-market trading activity in order to get a good feel for where the stock is going to open in relation to the parameters that you've set up. So here is a good example of how I put these things together. You see here that this is Apple. This is on a setup day, so I'm drawing my lines. I'm drawing my volatility bands, figuring out where the ranges are that Apple trades. So when I'm looking for these bands, what I want to do is focus on the most recent trading activity, because that's going to represent, generally speaking, a good idea of what's going to happen the following morning. So if the stock opens in line, I'm going to expect that Apple is going to trade around these lines that I've drawn on the screen here. And hopefully you can see why these bands are constructed in the areas that they are. They're encompassing some trading ranges, highs, lows, opens, closes. A lot of things are happening within those bands. My bias on this for the following session, my opening bias, is going to be the short side of the market. So what I'm hoping I'm going to see tomorrow is an open right around one of these lines that travels down through, and the first set of bands, in this case 149.90 down to 149.60. The next set of bands would be from 149.60 to 149.24. And that's followed by 149.24 down to 148.94. Again, this is what I am predicting is going to capture some of the volatility for the following session's open. So your later day trading from today is going to be predictive of your opening trading for tomorrow's session. By now, a lot of you have been following me for probably 18 years, and you know that I am just absolutely bent on I have to have a trading plan or I'm not interested in taking the trades. So just as I do with the Around the Horn plan, with the daily income trader setups, what I'm doing with the Around the Horn Nasdaq scalps is I am constructing this in a way that gives me a very easy roadmap to look at first thing in the morning. As you can see, I've got 3 sets of alternate entries. I've got my opening bias as a short. That's because the stock made a major downtrending move going into the closing bell, and I'm hoping that that trend is going to resume first thing in the morning. Now, you also should notice that I've got more than one stock that I'm looking at. Each one of these on the trading plan has 3 sets of bands. These could have 5, 6, 7, 8, 9, 10, as many sets of bands as you are comfortable dealing with. I like to have a group of 3 stocks to pick from in the morning, and then just be able to go through and sort of cherry pick which ones I'm going to trade at a given time of the session. Typically what I do is I draw all the bands on my screen and then I save it for the following day, and it's just the 3 that I consider the most likely to trigger first thing in the morning that I actually put onto this trading plan. The other thing that you want to make sure of is that when you're constructing this, you're mindful of the relationship between the volatility bands that you've identified and those floor trader pivots, because the pivots can bang a stock around pretty good, especially on the open. So you don't want to have a volatility band that's a penny or 2 pennies away from a pivot line so that you get triggered in and then immediately get caught up in a bounce. And on the really liquid super caps, when you're dealing with Apple, when you're dealing with stocks that trade very heavily in the pre-market, then you want to prepare to execute entries and exits at the opening bell by watching what's happening in the pre-market activity. Makes it very easy. So in this case, if Apple was trading at 149.65 before the open, then what I would do is put out a structured order saying if it gets down through 149.60, get me short, and then target 149.24. Those opening bell trades, the stops need to be a little bit wider than they'll be during the session. So you have to have a little bit more risk tolerance on an opening bell trade than you do once 5 or 10 minutes have passed and the stock settles in. So that's totally a judgment call on the part of the trader. As we see here, the stock was trading at 149.60 prior to the open and then was moving higher. And really our best indication was that we were going to open above that 149.91 line. But since it was as close as it was to 149.91, the thing to do was to watch the general momentum going into the opening bell and then anticipate where we were going to likely open up. In this case, waiting for the move down through 149.60 is not a great opening trade. The stock has to do a lot of travel range to get to 149.60 from where it's trading right at 9:29 in the morning. What you can do here instead is make sure that when you structure the order, you're aware that you might open below that 149.91 level. Your order might then trigger automatically. So rather than putting in a stop limit order that would just trigger you at 149.91, it's nice to use those conditional orders that we looked at earlier in the seminar, where you're able to say things like, if Apple's trading greater than 149.93, then sell short stop limit 149.91, stop with a 149.91 limit so there's no slippage, and then target that 149.60 line. So a structured order on this from above the line is the key to not getting your fingers burned right off the opening bell. And if you have your entry and your target set up, then the important thing to remember is that the stop that you're going to establish should have some relationship to those price by volume bars out on the right side of the chart, as well as the travel above that 149.91 line in that first bar of trading and that second bar of trading. So you can see here that in the first bar of trading, it got up above 149.91, came down, triggered in. Then in the second bar, got up as high as about 150.09. That's no crisis when you're dealing with the opening trading ranges, and then straight down to that 149.60 level and beyond. If it's a bracket order, it's going to take you out. There's no adjusting that order because that move is going to be very quick. You're not going to change it to a trailing stop or anything right there. And then as the session moves on, what you want to do is watch for moves up above a band, since these are short side sales, and then back down through it. Ideally, what I'm looking for is a move back down through the band from no higher than that initial stop loss level that I had on that first trade. So this high would be the highest that I would want to see the move back down from. And if it's not coming from that area, then the thing that I do is I wait for it to come up above. It might push down through without me, and then I look for that inverted check mark that you hear me talking about, where it goes back up above, tests it again, comes back down through. So that happens here, here, and here in the early trading. So in this case, 90 cents per share on Apple, just by following the rules of that early morning trading plan that we've put together. That's the basic trade in this one. This is a first hour version of the trade. These are also valid over the course of the session. You can go through and do some later session trading where you go and adjust the bands to see if there is an opportunity after the midday session is over with to capitalize on essentially what you're planning for tomorrow. But when you're putting together the following session's trading ranges, whether it's for today's session or tomorrow's session, I'm going to show you how to do some later in the day session stuff in a minute here, but when you're putting together the trading plan for the following day, or if you're looking at my trading plan for the following day, the thing to know is I'm always focused on the intraday ranges. I'm always focused on whether or not the trend is up or down for the initial trade. And I'm really biasing it towards later in the day. So in this case, again, we see that we've got Apple that has a move higher, and the move higher going into the close of the day. We've got 158.19 up to 158.37, 158.37 up to 158.60, 158.60 up to 158.90. Those trading ranges should be really easy to identify. So when you're looking at this chart, you should very clearly see there's places that the stock is bouncing to and from. It's traveling in these narrow channels. We're not looking for anything out of the ordinary. We're not looking for a move in a trading range in Apple that's 70 cents or something, because we know that Apple travels in these tight ranges, 20, 30, sometimes 40 cents. You should be looking for the typical, not for the outlier, when you're putting this together. In this case, as I said, we've got a long bias on this one for the following day. We've got nice tight volatility bands, a little bit tighter on the first one with 18 cents between the entry and the target than we would normally like. But still, it's worth putting the plan together and trying to see if we can't get some profitable moves the following session early in the morning and then later in the day. So for me, I don't only look at these as opening trades. I used to, or when we're doing first hour trades, I'm definitely only looking at them at the opening bell, but these will work out over the course of the day. You've got, once again, multiple opportunities on this trading plan. In this case, we've got Apple, Netflix, and Tesla. Tesla is sort of a special situation. Look at that price tag on it, $355. I'm going to get into how to handle higher price stock like that in a few minutes here. But for now, let's just review those basics. You want to get your nice tight volatility bands. You're going to use pre-market data to gauge the opening bias. And then if you do intend to hang with these over the course of the session, you're going to want to start developing new sets of bands over the course of the morning as the range expands and contracts. So in the first hour trading pit, of course, we're going through and posting the new bands as we see them. If you're doing these on your own, or you're just going to put together a grouping that you're going to want to look at over the course of the day, it's just important to remember that you need to account for the way that price movement's going to change once it gets out of yesterday's volatility and sort of develops today's biases just based on the current buying and selling. The one time you do want to avoid this altogether is during the illiquid noon trading hour. So if it's noon Eastern, in our case, that's 9 a.m. Since we're out here on the West Coast, those of you in the middle of the country, same thing. Just pay attention to when noon New York is happening and stay clear of this for a bit. I try to stay away from it from about 8:15, 8:30 Pacific time, and then I don't get back to it again until about 11 o'clock Pacific. That doesn't mean that I ignore that time altogether. What I do use that time period for is to establish new bands for the afternoon trading, because it does tend to settle into some ranges during the New York lunch The thing about it is it's just not generally going to agree with the ranges that I have on my plan from the day before. And then if I try to take those, I'm trying to force a bunch of trades, or worse yet, I'm getting in only to bump into those new bands that are forming and then winding up stopped out. So it's a good practice to just sort of stay clear then and then use what happens during that period to figure out what I'm going to be looking at in the afternoon. So let's look at this opening trade and see if we can walk through the logic of how to apply that trading plan. First thing we do is check the pre-market data. So this is what you see on the screen here. Obviously that data from August 7th goes into the extended session, and the data from August 8th represents some pre-market trading that's going on before the 9:30 New York open. We're going to check the data and see where we're going to open in relation to the bands that we drew the night before. And here what we see is Apple's going to open at or below 158.60. So we've got that 158.60, 158.59. Sometimes the lines aren't exactly band drawn on the screen. And we can see going into the opening bell that we're going to open right around there. And what we want to do in this case is, since we're looking for a long side move, I want to structure my order so that I enter 158.60 as I move up through it from below, and then I'm going to target 158.86. So there's a bunch of ways you can do that. The easiest, of course, is to go and set up a conditional order that says if last price is less than or equal to 158.55, 56, 57, whatever, then begin buy stop limit 158.60, stop 158.60 limit, and then go and enter your OCOs on top of that to target 158.86 and to put in your stop loss. You can see here why that was helpful. So Apple opened right at 158.60, then it dipped down below that 158.60 band, and as it moved back up through, real tick gets you in 158.60 and gets you out at the target. So why was it important to structure that order? If Apple would have opened 158.60 and triggered us in immediately and then started moving lower, it would have gone straight down to the stop. What this does is gives us a little bit of a test of that volatility band and then an entry while the stock is going in the right direction. The next thing we see happen, Apple trades down below our next volatility band. We're down at a 158.35, reverses, triggers us in as it's moving higher. This time, the exit is that 158.60 band. This is a long trade, so when it makes the check mark move in this case, down below 158.60, back up through 158.60, another entry opportunity, this time 158.60 to 158.90. And again, there's the opportunity to book 3 really nice profits right off the opening bell just by keying in on closing volatility from the prior session. Now let's say you hung around and you watch this through the noon hour. You can see what I was talking about. The noon consolidation is going to have no relationship at all to what you saw happening on the prior session's trading. And what we do is establish new volatility bands based on the price action that's happened over the session. I like to key in on those noon hour trades and then see if I can't find some opportunities later in the day based on the trading that happened during lunch. These bands that you're drawing should be the same regions that you would be looking at for the following session. So if you were setting up trades for the next day, those bands that you drew should be in the picture for what you intend to do tomorrow. So the later part of today's trading is really going to do 2 things for you. A, it's going to give you volatility bands for the closing part of the session, and B, it's going to get you ready for the next day. Your trades may or may not agree with your prior biases. So in some cases, you're coming into the current trading session with a long bias, and by the end of the day, price has reversed and you've got a short bias for the next session. So the latter half of today, your bias has also changed. If the stock started moving lower over the course of the day, and you're going to go out with a negative close, you're going to go out looking short into the following session, then you're going to want to make sure that the bias that you have for the current session also has shifted. In this case, you can see that there were numerous opportunities to get back into this after the New York lunch. So right around 1:30 Eastern time, you start watching this again. And by the time 2 o'clock rolls around, we've got a dip below a 161.08 line. That volatility band gives us this check mark move to the upside. Stock is kind of drifting for a while, but manages to get up and tag that 161.28 line. And then the next time that it manages to come up and give us an entry opportunity, look what happens. Gets you in and gets 50% of the distance to the target, winds up being a break-even stop, and then reverses lower. Out at break-even on that second one, if you're following the discipline, 50% of the distance to the target, I'm always moving my stops to break-even, and that then is how you set up your later day trades. Now, there's a very frustrating situation that can occur, and that's when you put in all the time to set up the trading plan properly, and then we get a gap. So here is an example. Apple gapped on us on this day, but when the market gaps, you're just going to keep those original volatility bands on your screen just to deal with a potential mean reversion either on that current day, on the gap day, or in subsequent trading days. So it could be the case that tomorrow we get back down into those ranges and they're still going to be valid. So I like to keep days and days worth of these bands up just so that I can see where things have been happening and where there's some confluence from one day to the next. But you need to prepare to create new bands based on the relationship of what's going on in the pre-market today, on the gap day, and then you need to make the changes to accommodate the new trading plan. Hopefully you've got something from prior sessions, even if it's 5, 6, 7, 8 days back, that is in line with where it's going to be trading today. No matter what, you've got to be very, very careful on a gap day. You're into a new range. Some of these things aren't necessarily tested yet, and you've got price elasticity to deal with. You might get bounces that you think are logical fills, but then when you get filled, you find out that rather than adhering to those trading ranges, there's elasticity around it because nobody knows where price is going yet. So it swings wider than it typically does. So since you know the stock's going to gap, what's really important is that you check that pre-market data, you figure out where the open is going to be, and then try to establish some pre-market volatility bands. In today's case, on this August 14th trade, the pre-market data was a little bit sketchy, so there wasn't really a good set of bands that we could draw, but we were able to anticipate at least where the open was going to be. You could have put on a decent opening trade, as a matter of fact, a very good opening trade on this, without knowing where the bands were going to settle in, just by using typical travel ranges for Apple and having an entry at that very first tick. The other thing you can do is just wait, just pass on it, and see where the new ranges establish themselves over the course of the morning. Once you get these new volatility bands formed, this then gives you the opportunity to enter on the violation reversals that we've been talking about, and you trade those bands then until you get a violation that is too extreme. In the case of these long trades, we'd be looking for one of the moves down below that 159.26 line that just gets so far down that it's no longer an acceptable stop, and then we don't take that entry to the upside like this one right here, which is of course during the noon hour, so you wouldn't want to do that anyways. But if it had happened earlier, you would have wanted to pass on that just because this dip was so big that we're expecting that elasticity all the way down to here now, and that's going to make for an unacceptable stop. So we want to wait until price comes back up and settles into a range, gets above it, dips below it, and then rides back up again. And you can see that the rest of the session here on Apple was pretty frustrating in that regard because it continuously bounced right off the bands, and we didn't get those tests below that we'd like to see. So today, not much going on in the afternoon trading, and that's okay because you really want to just make sure that you're taking the setups that you're the most confident about and that make the most sense to you, especially on a day like this where it gapped open. So this is just how you handle these days that fall outside the bands that you have planned. Things don't always go the way you want them to, and there's an adjustment you can make here, but it doesn't necessarily mean you have to be trading the thing all day long. So now let's move on to the last topic, and that's when we're trading higher price stocks with these scalper setups. What do you do to make the accommodation? Every stock's different. Every stock has its own personality. In the case of something like Tesla, for some reason on the trading plan here, the description isn't in the box, but we see that we've got some very wide ranges that we're looking for. Everything is 50 cents or so in terms of the profitability. That's a very big profit, but then realize that with big opportunity also comes significant risk. The risk is going to be much larger than on something like Apple that trades in these tiny little ranges. When you're dealing with these high value equities, bear the following things in mind. The trading ranges are going to be wider. Those bid-ask spreads are going to increase dramatically. This is a very different animal than Apple. The bid-ask spread on Tesla can be 40 cents, 50 cents at times, and you have to be very, very conscious of what's going on in that book when you decide how you're going to structure your orders. The targets are going to increase in magnitude. You're going to have much wider profit objectives, but those stops are also going to be proportionally larger. So the solution in my book is decrease the share size, knock the share size way back so that the amount of money to be made or the amount of money to be lost on it is just about parity with what's going on with the Apple trades. I know it's exciting to trade a high dollar stock. It's exciting to have the possibility of putting on a trade, seeing $1 in profits, and Yahoo, you're off to the races and you feel great, but it's also going to feel just as bad when you're booking 40 and 50 cent losses. So the range elasticity on a stock like this, especially on a gap day like today, so I intentionally picked a day where this one opened out of the range, just like Apple did. The range elasticity tests are going to really help you in figuring out whether or not you've got acceptable stops. So if you look at the early session, you can just see there was just no way to put together a set of bands that made any kind of sense. What you really had to do is wait for the stock to trade within some volatility bands that you could draw, and then only take entries when you had acceptable risk. And notice what happens over the course of the day. You've got a big gap to the upside, but before you know it, you've got a downtrend in place. And once that downtrend is moving the stock lower, that was really the only time on this session that I saw the opportunity to make the trades. That's why my trend lines on the big up day, the volatility bands, are all red, because I waited for the trend to be in place and then didn't have any opportunity for entry until just about 10:45 a.m. Eastern. That's when we had a move back up to the upside, bumped into that 365.67 line. That also slammed it right into the trend line and gave an entry which was just a few ticks below that volatility band that we had drawn on the fly in the morning. But you can see there that that band could have easily been a bit lower, could have been under some of the lows that were put in place as the morning went on. And that, in fact, then gets you in and trading down from 365.67, a full dollar move down to 364.67. These things, like I said, can be exciting to watch, exciting to trade, but the reality of them can be pretty brutal if you don't pay very, very close attention to what's going on with the bid-ask spread and with the range on those bands. What looks like a couple penny move above or below one of those volatility bands can really wind up being something that's 30 or 40 cents, depending on what the typical bar range is on the day. So that's just a word of caution when you're setting these up. I know some of the super caps are very high priced, and it's the movement in those things that's attractive to people. Just realize the movement can also make them very unattractive. So if you feel like Scalper was the best reason for being here today, if you love this style of trading, then we've got a great deal for you on this as well. You can become a member of my Around the Horn Nasdaq Scalper Trading Plan for 2 months, a member of the First Hour Trading Pit for 2 months, and also take the Gap Trading course all together in the seminar bundle for $199. We decided to include the Gap Trading course here as well because we talk about the gaps quite a bit in the First Hour Trading Pit, and I want to be sure that everyone is on the same page each and every morning. So altogether, the bundle is a $687 value. You'll save 70% when you order the seminar special today, and you'll have immediate access to the Scalper Trading Plan, the First Hour Trading Pit, and the Trading Opening Gaps course. Once again, to access the special, you can click on the special offer pop-up that just appeared in the top right corner of your screen. If that vanishes before you can click on it, just hover the mouse on top of the right corner of the video, and you should see it come right back. So I hope to see many of you take advantage of the additional training that we offered here today, as well as in the first hour trading pit. Now, listen, I know your time's valuable, so I also want to thank you for attending and staying for the whole thing. I believe the replay is going to be available in a couple days at traderinsight.com. So if you feel like you missed something, you can watch as often as you'd like. Now, if you have any questions that I didn't answer today, please feel free to email me at adrian@traderinsight.com. I'll either send you back an email reply with an explanation of whatever it is that you're questioning, or I will send you back a phone number that you can reach me at, and we can just talk through it if it's easier to do it that way. So have a great day, and again, thanks for attending. I hope you got something out of this that you can get up and put to work tomorrow.